Hello, everyone, and welcome into our State of Freight for August. My name is Marianne Hensley. I'm the Vice President of Marketing for FreightWaves Sonar, and I have to tell you, I am super excited to be here today. We have a live studio audience, and I am joined, as usual, by our founder and CEO, Craig Fuller, along with our Head of Freight Market Intelligence, Zach Strickland. They will be here to discuss all of the great things happening in the freight industry today, as well as the not so great things and what we can expect over the coming months. They'll also be here to take our audience questions live following the discussion. So without further ado, I will go ahead and turn it over to them.
All right. Thank you for that, Marianne. And we should state that this is also the kickoff of college football season.
This is the most important day of the year. It is our first live in-studio State of Freight, but it's also the opening of college football. In fact, there's something like 30 games tonight.
Right.
What game on the schedule are you looking forward to most?
I think there were two specifically for me. I believe Minnesota and North Carolina were the ones that I cared about.
Colorado and North Dakota State,
Okay.
which most people in the FBS don't follow the FCS.
Well, Coach Prime, the resurgent story for the Buffs out there. And, you and I have a friend that went to Colorado, and I've heard all about it. And she celebrated her birthday a few days ago.
Well, a lot of people celebrated Coach Prime last year until the first couple of games he did okay, but didn't.
I don't know. Colorado's always a good story, but yeah. But of course, the focus of today is also on the freight market itself, Craig, and we would be remiss if we didn't kind of start talking about, okay, it's about to be Labor Day. I consider that kind of a secondary holiday period for the freight market where we start to see some capacity, have some disturbances, some disruptions. What's your take so far? I mean,
look,
are we flipping?
Yeah, fall is a great time of year for, it is college football season.
Right.
It is, Halloween is coming up, but for freight people specifically, that time from Labor Day to really December 15th is just an amazing time. And you make your money during that period of year. In trucking, when I was in asset trucking, they used to say you basically, first quarter, you just hope to get out of it alive and break even. Second quarter, you hope to make some money. Third quarter, you hope to, again, just get by. You made a little bit of money, but not great. Fourth quarter is where you make all your margin.
Right.
That's really the most important quarter of the year. And it's largely driven by holiday goods. And this is really truckload. If you look at other parts of the freight market, flatbed specifically, fourth quarter is a pretty slow time of year. There is some Christmas tree movements and other specialized commodities. But the great thing about the fourth quarter for those over-the-road truckload operators is this is where they make their bacon.
Yeah, and of course, we're about to hit, I think, what I would consider the kickoff of long-haul freight season. This is where Los Angeles and that intermodal sector really have their moment in September. We get hurricanes sometimes that kind of pull capacity.
By the way, we should talk about the hurricane season.
Yeah.
It has been a disappointment from a...
I don't know about disappointment.
I mean, it is... All right,
let's pull Kaylee Nix out here and talk about what a disappointment.
That sounded wrong. It has been a year that has not lived up to the hype.
Right.
So
yeah, we were supposed to have a record-breaking year, 26 storms.
We had one hurricane that was really early, and then we had the other storm that hit Georgia and just stayed off the coast, but pummeled all the rain.
Right.
But in terms of actually disrupting the market, I think a lot of truckers are disappointed in the fact that there hasn't been a disruptive event. So this year, I think it is all about the holiday season. September is a big month for hurricanes, but we're not seeing any signs. In fact, ocean temperatures have dropped in a really strange sort of phenomenon. And so, what's happening right now is the hurricane season doesn't appear it's going to bring any levels of what it.
It only takes
promised.
one.
It only takes one, but what is certain is the holiday season. And one of the things I think is really interesting is that the ocean container movements have actually, I think, foretell what we're about to see in over-the-road trucking and intermodal.
Well, let me pull up the charts that explain this so that we can have everybody see the data that supports your claim here. So I'm pulling up the IATI, the Inbound Ocean TEUs index here. And this thing is really, just to put this in context, this shocks me at how crazy this data set looks. So you're looking at the white line is the current year, and I left the pandemic era on here in the green and orange. So those are the pandemic era years where we had this flood of imports. You remember, for anybody watching, listening, the pandemic era was really characterized by this outsized flow of containers coming from Asia to North America, mostly into the port of Los Angeles, Long Beach, and it crippled the infrastructure. Right now, we are seeing bookings data. This is measuring bookings at origin, estimated time of departure, coming to the United States, and we're on par with that right now.
The volume's high, but there's something that isn't obvious in the volume data. The reason we're not seeing disruptions is because what was happening last time during peak volume was that it was not just the big box retailers and importers, but it was everybody else.
Right.
And what was happening is you had manufacturers that were missing certain components. You may have a whole ship, maybe 50% Walmart, 30% Amazon, 10% Target, but you had like 5 containers that are on there that run some machinery part that is needed for some other module on some assembly line.
Right.
And all of that backlog wasn't the volume of containers, it was the fact that a lot of the SMB shippers, the importers, didn't have access to their goods as well. And a lot of that material was impacting the small importers. The reason we're not seeing a supply chain crunch or a supply chain inflation is because what's driving the volume today are the big importers and the big box retailers, and not a lot of the other importers that make up the broader part of the economy. During COVID, it was not only the big box companies, but it was also the SMB importers. Whether we were building a house and we were ordering custom windows, as an example. These things came from Germany.
Right.
They were getting stuck, like 10-month lead time. That isn't happening right now. What is happening is a lot of volumes being driven by Chinese imports. A lot of those Chinese importers, their domestic economy has really struggled.
Right.
They built out a lot of manufacturing capacity during COVID. They really need to find some place to sell those goods, and the American consumer has proven resilient, and that is what's happening. The retailers are soaking up those imports and those global manufactured goods at significant discounts, and they're taking advantage. And that's what you're actually seeing in that container data. Yeah. Now, the good news is that will show up in truckload markets at some point. The bad news is that it is really concentrated in those companies with sophisticated and built out logistics networks. It is not concentrated in companies that have really small logistics networks and need to buy a lot of incremental capacity.
Right. So one of the components of this too is that like I said, the infrastructure, the domestic supply chain infrastructure was taken off guard with COVID for all intents and purposes. Do you agree with that statement?
Yes, I think the global infrastructure was taken offline. And I think what we saw was a surge of goods driven by both Fed, monetary and fiscal policy, driving so much money, so much consumption into very tight bottlenecks.
Yes, and then the ports.
The ports were the bottlenecks. Yeah. The railroad yards were the bottlenecks.
Exactly.
And when you bring so many goods into those bottlenecks and they get stuck, if you think of you kind of nerd out here for a second, a denial of service attack. Like a denial of service attack is a way in computers that is effectively what happens is things get backed up and the computer keeps asking for more and more requests, and all of a sudden the system just crashes.
Right.
It's exactly what happened during COVID, is that things were backed up in this really significant bottleneck, and people were ordering more. And then what they ended up doing is, because they didn't know if they were going to get their hands on those items, they would order even more from other vendors. And so it created this massive inventory overhang that we've been living in for the last couple of years, and that appears to be over with. Yeah,
of course, inventories have largely corrected. So I want to pull up one chart that's a little in the weeds, a little specific, so bear with me here. This is the long-haul outbound tender volume index from Los Angeles. So this represents loads moving more than 800 miles, leaving the Los Angeles area market. And then on top of that is the domestic intermodal Los Angeles outbound component. So domestic, this is stuff that's literally getting transloaded onto a 53-foot container from probably some international containers leaving the ports. the port area, I should say, and crossing the country. Los Angeles, to me, has become kind of this bellwether, or maybe just this centroid of global supply chain activity. And I feel like, and again, correct me if you disagree, that this long haul component out of Los Angeles is getting relief that did not occur during COVID from the rail yards.
Absolutely.
Yeah.
And the rail yards, one of the things that isn't discussed a lot is the fact that the railroads, the port operators were dealing with COVID issues. You may not remember, the whole COVID period feels like a blur.
Yeah.
Like, it almost feels like we lost 3 years of our life in this, like, just doing the same thing every day, sitting at home. But there was periods of time where there were COVID scares and COVID distancing, which meant that the port would shut down, or they would have a crew that would get sick and they would shut down a crane or something. That isn't happening right now. And so what we've seen is a lot of capacities fully back online. This new railroad contract, not the one, I'm not talking the Canadian contract or issues, but I'm talking specifically about the one that happened a couple of years ago, has given the railroad operators a lot of security in labor. We've seen the longshoremen on the West Coast also get that. All of those issues are behind us, and that's allowed the railroads and the ports to operate as efficiently as they possibly could be. And one of the things that's also not appreciated is that a lot of the port operators, the truckers, and the railroads made a lot of incremental changes to their operating plans during COVID because of the volume that we're now benefiting from that. Look, the government infrastructure bill does impact it, but that takes perhaps a decade to play out.
Right.
But we did see a lot of operational changes during that period that we're seeing the benefits of. And that's why, Bloomberg's chief economist wrote something on Twitter, I think it was 2 weeks ago, warning, looking at the volume of containers and saying she was really worried about inflation and how this would impact supply chains and the fact that we could repeat the COVID period. I commented on that thread that I disagreed with her. And the reason I disagreed with her is what's driving this particular surge in goods is different than what drove that surge in goods. That surge in goods was caused by so much moving through the economy, and you couldn't get your hands on anything. And sales were, if you had products, you could sell them. That drove a lot of sort of perverse issues. But a lot of what we're dependent upon in a supply chain is dependencies. And so if you're a manufacturer in the United States and you need raw materials, a lot of those raw materials were stuck on container ships that were way out in the bay. We're not seeing that right now. So the idea that this is going to create supply chain inflation, I just don't think is real. But what is good for truckers coming, and to your point on the railroad side, is that volume that we're seeing, we have the capacity to support it. We have the infrastructure to support it. Retailers and importers know where to shift that volume to other ports. They become much more resilient. This is the great thing about the supply chain. It is a self-healing network.
Right.
Like, when there is a problem, it will heal. And everyone loves to talk. And look, we are a cause of this issue at FreightWaves in the fact that when something happens, we love to talk about the issues. In many ways, it's supply chain crisis porn, right? Like this stuff happens, we talk about it for weeks and months on end, and then it goes away. But what happens after that is companies have ran contingencies have found alternatives, they've ran contingencies, and those issues are unlikely to disrupt stuff in the future to the degree that it did before. Because once you've learned it, and once you've experienced it, you tend to not have those same issues in the future.
So speaking of issues, so we have the upcoming ILA, East Coast port issue, where the longshoremen, of course, their contract expires September 30th. And there's a lot of concern, and rightfully so, around what that means for the domestic supply chain environment, as of course, the East Coast ports are potentially going to shut down. Now, I think the data supports that a large majority of the freight has already kind of been diverting to the West Coast as is. Is there any kind of unforeseen issue that you see coming from this?
I had this conversation 2 weeks ago. I was talking to a number of CEOs that are not, some of them are in freight, many of them are not. We're worried about the railroad strike in Canada. And it was the day of, by the way. And it was that morning, and they asked about the railroad strike. And I said, I don't think it matters. And the reason I don't think it matters is that when you have something that is so integral to the supply chain, that's so integral to the economy, the governments, and Canadian government, US government, cannot afford to have a massive shutdown of something that is that critical. Think about the timing of what you're talking about. You're talking about the end of September. You have a U.S. election that's coming up in November. You have a very contested election. You know, when we got together last time, it seemed very clear that the election was going to end up with a very specific result. Donald Trump, you know, this was when Biden was still running. It appeared at the time that Donald Trump was going to win it in a landslide. It now feels much more contested. I don't think the administration, which has been arguably the most labor-friendly administration in decades, can afford to let a strike go on to disrupt the holiday season. They will likely put it into some type of arbitration. The administration will do everything it can to avoid a strike or a shutdown before the U.S. election. And so they just can't afford it. And I think frankly, if I'm the union, the worst possible time to have my contract come up is right before a U.S. election, because there is no way that the Biden administration or the Harris administration can allow for something catastrophic to happen to it. So I think retailers are smart to make plans and contingency plans. The good news about holidays is that these are not black swan events. These are not situations where you can't plan. And the nice thing about strikes is they're well telegraphed, well ahead in time. They're not black swan events. You know they're coming. And we have enough ports across the entire United States to be able to find contingencies. And people are already used to dealing with it. I mean, COVID brought a lot of new behavior into the market, and it forced supply chain managers to plan differently and make contingencies that, frankly, they benefit from. I remember talking to some shippers during COVID, and they only moved freight into the West Coast. And the response was, why don't you move it onto the East Coast or into Houston or Savannah? Was because we have all of our infrastructure set up here, our 3PLs are set up here. If we have to disrupt that, we will lose that. And that was sort of at the early days of COVID. By the end of COVID, they'd already done it. And they were finding contingencies because they didn't have a choice. And I think a lot of that has stayed with us. And so we've benefited from this. This black swan event that we dealt with COVID has prepared us to handle a lot more volume.
Yeah, so let's shift gears a little bit here back to kind of the macro freight environment. And I want to talk about capacity. We're still in an environment where I believe the data suggests that we still have plenty of capacity. A lot of these disruptions are getting ironed out. If we pull up the Outbound Tender Rejection Index, this is kind of my leading indicator for, is there something to concern yourself with in terms of sourcing capacity right now? And right now, I'd say no, not really at all. And the fact that we're below 5% leading into Labor Day, we're starting to see some uptick in rejection rates leading into the holiday, but it's not outside of what I would consider like expectation. Like this is kind of people coming offline, going on vacations for a minute, probably come back to work a few days afterwards, and everything kind of resumes. We've got some lead times increasing a little bit, but it's not really that disrupted from the standpoint that we normally see, like July 4th. If you look at the rejection rate spike around July 4th, we were pretty strong this year compared to last year. This year, in Labor Day, we're not showing a strong year-over-year growth in rejection rate. We're still in the similar space. Do you think that this 2019 alignment, which the 2019, I should say, is in the orange line, the current year is in white, and then last year is in blue. So we've definitely tightened, but we're not seeing a big breakout.
There's something in the orange. And the reason I say that is look at that chart. You got the white and the orange chart. And they look, there's a little bit of gap, a little bit air gap in the white line to the orange line. So we're looking at 2024 versus 19. But if you look at the trending, it is incredibly similar. And it really has been since really what we saw was the 2018 number sort of converge on the 2024 number. And this looks like normal seasonality that we're now seeing. Very similar seasonality to what we saw back in 2019. And let's sort of go back in time for a second. For those that may have not been in the market or may have forgotten, is 2019 was the year of the 2019 trucking bloodbath. It was one of the highest numbers of bankruptcies in trucking history. It was a year that was pretty dire for a lot of carriers. We lost a lot of trucking companies. FreightWaves.com was reporting at 1.10 bankruptcies a week. It was just a year that was really difficult. But we came out of it in the third quarter. At the end of the third quarter, you can see it in the chart, is that things started to really turn around in September and in October. And I think we could very well see that. And you may not remember this, Zach, but when we sort of get to 2020, we've all forgotten what 20 was coming in. But I went back and looked at some of the articles I was writing at that time. And some of the stuff that was being written was this very bullish expectation about the year, is that the market was coming back. There was a lot more optimism about the freight economy. There was a lot more confidence in capacity leaving the market. I think we can very well see a repeat of 2019, where the chart that we're seeing in orange will be a very similar chart in white. I think the only issue, or the only sort of major discrepancy between 2019 and 2024 is the fact that you have this Fed that has a very different orientation than they did in 19, where they're about to cut interest rates.
Right.
And that is going to be interesting to see how that plays out. I run some magazine businesses that are in the boating market and the aviation market. These are big ticket, typically big financing businesses. A lot of people are waiting and seeing. What they're doing is they're not going to make the airplane purchase. They're not going to make the boat purchase because they know that interest rates are coming down. They don't want to deal with it. So I think there's a sense of the consumers that they know interest rates are getting cheaper. And so they're going to hold off on some of those big ticket purchases, just waiting for interest rates to fall. And so in some of the big CapEx spending, I think it's the same case, and that will hold back some spending. But we could see some acceleration as we head into the end of the year. Now, I was going to say it's an election year, but then I reminded myself that when you look at 2019, we were coming into an election in 20 that was starting to play out at the end of the year. That also could be a fact, and I think we should probably talk about that because that's a factor. Is that 19 didn't have the election? It was kick off the election,
Right.
but the vote was actually the end of 20. That also I think has some impact.
Well, I kind of want to stick on this capacity thing right now too, because I think there's a big difference in the speed with which capacity is exiting, the amount of capacity that was oversupplied coming out of COVID. Very different things from 2019. We're scaled up in terms of the bubble popping mechanism that was 2019. John Kingston, of course, covers the BMO Transportation Group, former Bank of Montreal. He tweeted this and then wrote the article on FreightWaves.com about their allowances by quarter. Now, allowances, of course, are basically the expectations for bad debt, things that are, and 90% of their portfolio is North American trucking companies. So not just in Canada, but North American trucking companies. And this chart is alarming to me. Like the speed of the bad debt expectation growth here.
Why is it alarming? It's a welcome thing.
I mean, but at the same time,
we've been waiting for this, Zach.
I know.
Like we have been waiting a long time.
This is still shocking that it popped
can't
up
be
like
shocking.
this.
Did you see how many trucking companies came into the market?
But look, I mean, we've been a freight recession. Now, we watch this all the time. Explain to the audience why all of a sudden, why is it so bad now versus where it's been? Because
we put so much money into the economy. We gave away loans. Like the whole SBA loan provision is your answer. These ridiculous loans that went out to the entire economy, $400 billion in SBA loans. And here's the ridiculous part of it, is for 2 years, they didn't have to service the loans. Like the SBA gave out $400 billion, of which $38 billion went to trucking. It allowed operators to survive the downturn because it, on average, gave $90,000 in loans that were not required to be serviced for 2 years. So they were able to absorb all of the downturn in the freight market because the government had given them money that is currently priced lower than treasuries on a 30-year amortization. This is a mortgage.
At 2%, 2.5%?
3.75%.
Okay.
And so that is what's happening. The problem is that it kept so much capacity. Look, I'm all for, I think, in hindsight, the government responding aggressively in the crisis, in an unprecedented crisis, made absolute sense. And I think what they did in 2020 made absolute sense. Maybe you could even argue in early 21, because we were still dealing with a lot of the COVIDness in there. But there was a point when they had to pull the punch bowl away, and they didn't. They continued to double down, and one of the things that they doubled down on was this SBA program. That is what kept capacity in the market, and that's what you're seeing. Zach, pull that chart back up, because I think everybody should see what you're talking about. Is that those numbers right there? The fact that we have finally seen a breakout candle, the fact that it's breaking out is the best news of all. Now, not for the people that are on that chart,
Right.
but for the market, that's the best news of all. Because what we want to see is we want to see a point of capitulation. We want to see operators that have stayed in the industry that do not have sustainable businesses leave the market, because this market needs a reset.
Right.
We need to wash it out. We need a reset. That is what we're looking for. And I can tell you this as well. Anecdotally, when I look at FreightWaves.com and the bankruptcy report, which we arguably have the best bankruptcy. I had someone who's a distressed credit bank, not in trucking, that knows my wife, and she found out they read FreightWaves every day at this bank, and nothing to do with trucking, because we have the best bankruptcy coverage. Now, that says more about our industry than it does about FreightWaves, but the point that I'm making is that we have been covering bankruptcies throughout the freight recession, but there hasn't been this significant increase in the number of stories up until the last 4 to 5 months. We have seen an acceleration in the number of stories. This is wonderful news. I hate the fact that people struggle. As someone who takes risks in business, it sucks. No one wants to lose their job. No one wants to lose their business. But this is the way that the market works. We need a reset. And that chart that you showed is the sign that we're starting to see capitulation. There is no free money anymore. It is now you have to get back to work, and you got to run a trucking company that's profitable. If you don't, you'll be out of business.
Right. So I want to pull up kind of the industry standard, or it's been the industry standard data to kind of tell us, like, what's capacity doing? How's it moving? And it's net revocations based on FMCSA data. So the trend here, and we normally don't talk about this in this format on this show, but we normally talk about net changes. But I think most of us in the industry have been watching net revocations, which is simply just the number of trucking MC numbers exiting active status from the FMCSA. And it's been trending lower. Now, there's an obvious flaw here with this data and the way that it's telling us that
it's government data?
Well, besides that, but the way that it's trending would tell me that things are getting better. Tell everyone here why that's, for operators in general.
In terms of why it's getting better, or why it's flawed?
Why, either way.
What is my interpretations of this?
Yeah, what's your interpretation of net revocations going lower? And I'm looking at this as an outsider going, well, the trucking market's actually getting better. It's stabilizing. Things are getting easier.
Well, I think you want more revocations, right? We want more capacity leaving, and I think you need to see it. It has slowed down. And I think the revocations, you want it to stay at a place where we keep seeing companies leave the industry. And so the one thing to keep in mind is if you go back to sort of 2010 to 2020 historical pattern, we were adding 200 to 400 new trucking companies a week. That's in a really boring, stable part of the market where there was still expansion. As GDP expands, you're naturally going to have expansion of trucking companies. Right. So the fact that we're still losing carriers in terms of revocations just suggests to me that that the market is coming closer in balance. You wrote an article a couple years ago that actually was very controversial about the fact that we had something like 28% more capacity than we needed, and it was going to be the first quarter of 2025 before we got rid of them. You got a lot of heat for that, and I want to say so far you've been right.
So far.
People said there's no way that we added that much capacity.
Yeah.
It absolutely has happened. Jason Miller has gotten it wrong yet again because he misunderstood using government data how inflated this market had gotten.
Yeah. And the fact that this data is also very slow.
It's slow.
It's very slow.
It is slow. It's based on active authorities.
Right.
Or inactive authorities.
It takes 2 years to get revoked.
And so it takes a lot of cycles.
Some of those numbers get floated around.
The good news is it's slow, and the fact that it's still trending means that we're still losing a lot of capacity. But I don't spend a lot of time here. Everyone asks about this chart, and it's important because it's an important signal. It's a proxy. The problem is it doesn't tell you a lot about the conditions of the market. The stuff that I think that I would want to understand if I'm in the market is the tender rejection data, because the tender rejection data is a real-time sentiment indicator on whether carriers are going to pick up your freight or not. And if they're not picking up your freight, It's one thing to look at an individual trucking company, why they're not picking up your freight. They may have a driver that's off duty, they may have a driver that got sick, they may not have a truck. Someone across the street, another customer may have paid more for that load. When you look at over a market, those individual discrepancies are weighted out of the whole index, right? Like it is not going to address the individual issues don't matter. That's why the tender rejection data tells us how carriers are thinking about capacity in a real-time basis, and that's why it's a very important factor. The whole number of revocations is a great story. Journalists love it. FreightWaves.com people love it. At the end of the day, it is a lagging indicator. It is a slow indicator. It does tell us how inflated this market became, but it doesn't tell us a lot about how fast it's going to come down.
Right. Yeah, I think that's valid, and also the fact that a lot of the weaker operators are part of that big bulge you see in the beginning.
Absolutely. And the other thing about authorities is it doesn't tell you a lot about individual trucks.
Right.
And it doesn't tell us a lot about whether the people that are in the industry that work for one company went to another. Like there's a lot of data, a lot of noise in that data.
Yeah.
All these data sets have their own flaws, and even tender rejections do, volume does. And it's important, I think, in any data set, it's important to know what the data is actually telling you. Why can it be valuable? Where is it going to be flawed? And you can't find a single data set anywhere on any methodology that is going to be absolutely accurate. And that's the thing that I think oftentimes people in this industry are like, I want the magic number. I want to know what is going to happen tomorrow, and I need to know which data set to look at. And the answer is you have to use a couple of them, and you need to know where they're flawed so that you can address them appropriately.
Speaking of magic numbers, I think I have two of them that I think we should address, and then I want to get to your. This is kind of the first step of your favorite thing to look at here: the contract rate and the spot rate. This is dry van centric, but
can you pull it up my way?
What? Oh, you want to see rates? Okay. Well, here's
you can stay here.
Well, anyway, this is contract versus spot rate. We're going to look at your way in just a second, but I wanted to, there's something that your way doesn't show us implicitly that I wanted to point out, and that's the fact that the contract rate, which is in the white line there, is now starting to trend up. We've actually started to see the front edge of a turn. Now, it's very short, and it's not a long-term signal at all, but it looks like rates on the contract side are starting to turn up, a signal that we've seen already out of the spot market for the past year. Spot rates have been starting to slowly climb.
It's true. The thing that isn't as obvious in that data is mix is a really important thing.
For sure.
And I think what you aren't addressing in that data point, and national data doesn't do this very well, again, understanding challenges with it, is that length of haul will impact it. The, what markets are doing better will impact it. There's a lot of factors that impact it. It is good to look at over time. The fact that it's at bottoming, I think, is more important. Like, is it trending up? Yeah, you could look at that and argue for the last, month and a half, 2 months.
Yeah.
It is bottomed.
Yeah.
But we're not seeing it break out in any sense. I mean, you could look at what's the old cup and handle thing? Like, it's like we formed a base, and I think it's fair to say that contract rates probably are not getting cheaper. What we're going to see now is this inflection where rates, my favorite index is coming on spot indexes. Pull up rates for a second.
Yeah.
Rates, I think, is a really important index because it shows us the delta between the two data points. So the reason I look at it this way is it's a simpler minded. I'm not as dialed into the multiple charts as you are. And what this does is it gives me an indication of what the spread is between contract and spot. A zero number means that if it's below, it means that spot is cheaper than contract. And then if it's above in green, it means that spot is more expensive than contract. In a normal market, it is always red, right? It should be below zero, and 35 to 50 cents when you strip out fuel surcharge. Whereas 62 cents. And what I think is really cool is that it's trending up. It's getting into more normalized range. The market cannot reset until that's in more of a normalized range. It is getting close to there. It also tells us we have a little bit of room to go before the market is truly in balance. But we're getting much closer to that. And you go back to look at 2019, which is right there at the end of the chart. You can actually see that in 2019, that was that 35 to 50 cents that I talk about. We're getting close to that. We're still got some room to go.
We still got a good ways to go. Now, I have been asked the question like, well, as an asset-based carrier, my spot rates are already in alignment with with my contract rates. How would you infer in that situation?
Well, you mean that they've taken their contract rates so cheap to match spot rates?
Or would it be the other way around?
I mean, the spot rates have come up. I mean, look,
spot-
again, it's all about concentration. It's, the whole thing on that, we talk about these national trends is that we're looking at a very large sample of data, both on the spot and contract. And so it is a situation where individual companies will have their own individual experience. But when you look at it on a national basis, you get a much better sense for the whole market. There's always going to be companies that can find discrepancies in any point of data. And that's just the way the market works. Our job is to provide a universal data set that you can draw your own conclusions, and getting caught up in the actual individual number on a national basis isn't that important. What I always look for, and I've said this time and again, is the direction of the chart. What we're seeing in the rates chart is a slow but steady increase or decrease, depending on your perspective. That number is coming closer to zero. And rates coming closer to zero is telling us that the market is becoming more in balance. What we saw during the COVID extremes is that we saw a collapse in that spread, and it's coming back into balance.
What would you say the odds of that moving sharply are?
Significant if we see a big holiday push. If we see a big holiday season, then we could see a significant breakout. And you've seen it. I mean, will it repeat 2020? Probably not. But it won't take a lot to compress. And really, what you need is you need spot rates to go through the roof, and you need contract rates. Contract rates are just slower to move.
Right.
That could move quickly. And we saw a collapse in it. Could you see the inverse of that? I don't think to that degree. We've already made up maybe a third of the ground.
Right.
But could we see it move up by 20, 30 cents a
Well, could we
a
see
mile?
that BMO reflection that we just
No,
saw?
I don't think so. I don't think so short term. I think we could see that in the fourth quarter, but certainly, again, that is all about reserves of bad debt reserves, which they're doing mark-to-market accounting on likely some model of who's not paying or who's unlikely to pay. Like that's what they're doing there on reserves. And that is based on the history. I think the BMO data is going to look a lot worse. I think we'll be sitting here in a year and you will be like, man, that chart looks a lot worse. Just because I think they had been, I'm surprised it's taken them as long as it has to get to the level that we're talking about. But I think when we look at this stuff in a year from now, is the chart that it's at today will actually look quite similar to what we're at in the future.
Yeah, so I want to pull up the OTVI, the Outbound Tender Volume Index, because a lot of what you're telling me is you're saying some of the most inherent risk in the market for a flip are going to be demand side generations from the peak season environment.
It's holiday.
It's holiday season. We see it reflected in the IOTI to an extent. We see that's a lot
It's all
of
imports, man.
import volumes coming into the country. The OTVI still has plenty of room that it could grow.
So 2022, yeah. I mean, the OTVI is based on truckload volumes.
Right.
And the OTVI is lower. And the white line is 2024, green being second bears 2022. There is still a gap between those two numbers. It is certainly possible, and maybe one could make an argument, probable, that as we move into peak season, we will see an acceleration. Here's the great thing, is that those goods that are being imported are imports for consumer consumption. 75% of what gets imported through containers are consumer goods. These are predominantly, those import volumes are predominantly big box retailers with huge balance sheets and big sophisticated networks and big marketing budgets.
Right.
And you know what they're gonna do? Is they are going to try to liquidate those goods as fast through the holiday season because they need to get that stuff out of their inventory, that they were able to take a lot of advantage of a lot of price discrepancy out of China, but they're gonna want to get that stuff moving. And so I think we'll see them put it into the economy, into the freight economy quickly as we move into the fourth quarter. And I think that's a reason you can be relatively bullish about the end of the year.
I mean, and you talked about the interest rate cuts. Like we haven't, I think what you said has already been reflected. Like I talked to Dr. Zach Rogers. He says the exact same thing that you said, and that's the fact that we have this whole sector of the economy literally sitting on CapEx, that they're waiting for the interest rate cut.
There's two things that drive CapEx. One is tax policy. I mean, a bunch of things drive CapEx, but there's things that manipulate spending on CapEx. One is tax policy. There is the bonus depreciation, which is currently 60%. It will go to 40% if there isn't a change in that direction next year. So if we get a non-contested election and it looks like Donald Trump is going to win, then you may see companies actually sit and wait for bonus depreciation next year because they're better off writing it off 100% than writing off just 60%. So we could see that. The other thing is interest rates. Interest rates will have a huge impact on how companies think about capital spending and CapEx. And the Fed has already come out. Jay Powell came out in Jackson Hole last week and said that the Fed feels like they've accomplished mission accomplished.
Put a bow on.
He needs to have a flight jacket on an aircraft carrier. Mission accomplished. But he's been able to solve for inflation. And they're now worried about the employment picture, which I don't know if you saw this, the employment revision data, where, I had dinner with the Federal Reserve does these beige book meetings with CEOs and communities. And they were in Chattanooga about 4 months ago, and they had dinner with a couple CEOs. And we were around this table talking to our beige book person out of Nashville and telling her that we didn't believe the employment data because she kept swearing how great the employment market is. And we're like, we don't believe it. And it wasn't because we thought the employment picture was bad, but it certainly did not feel like a tight labor market. Because if you post a job today, you will get, I feel like I'm gonna do a ZipRecruiter's commercial, hundreds of qualified candidates. That's what it feels like. 4 years ago, 3 years ago, it wasn't that way at all. You couldn't get any candidates. And it's changed where it is very easy to hire. You put out a job, you're gonna get dozens or hundreds of candidates. That's a total change. The employment picture, the Fed came out, or the BLS came out and said that they had overestimated job placements by 1 million people. And when you look at the unemployment rate, it's quite different than what they had reported.
I mean,
most people knew something was up, but it is interesting to see how when it's finally admitted.
Knowing that those job openings did not decline at the rate at which everything did, freight market data declined rapidly. Job posting data, you have these ghost postings. You have things that are stale
It's the same thing with load board data. You get a
lot of the BLS, the government data in general, is based off an environment that no longer exists.
Yep.
And a lot of their methodologies need revision over time, and I think that's what we're seeing is
a lot of those people also in the tight labor market. You also have people working for Uber and DoorDash and independent contractors. It doesn't address the independent contractor model, and that's a huge part. The gig economy is a part of it. So that data has been flawed, but it's been telling a story that has been quite different than what most employers have been experiencing. And it is frankly a lot easier to hire candidates today than it was a couple years ago. And people, employees are not moving. Like we saw a period, 3 years ago where you just had this constant movement. Employers were constantly thinking, okay, what do we do in an environment where our best people are taking these dream shots and we know that we can't hold them here, but we can't hire new people. It was a weird time. Now you're in an environment where you can hold on to your better people typically, and people are the employers have more leverage than they had before.
Yeah, I mean, I think it's an obvious statement, but I think, again, government data is definitely a warning sign. It's hard to imagine all this monetary policy being set off of this data set too.
But
It makes us nervous.
It is. I mean, I remember I spoke at an event in Arkansas in early 2022. It was like April of 22. We had just come out with our Freight Recession article. And I was a keynote, and there was a Fed analyst out of the St. Louis Fed also keynoting right after me. And we were talking about two different economies. I was talking about the collapse and the Great Freight Recession. And he was talking about how great the freight market was, like how great the economy was. And it was like, and JB Hunt was in the room and some other executives, and they're like, you guys are talking about, you're almost like in two different economies, two different planets, because it was there was such a discrepancy between the high frequency nature of the data versus the Fed's data that is using very old school data, very stale data, and it was obvious that there was a big disconnect. Now we know what has ended up playing out is what we were seeing in high frequency ended up playing out, just took them a long time to figure it out.
Yeah, it's like we're looking at stuff from all over the country, the world, et cetera, on a daily basis. A lot of these people look at data that's literally
Dude, the federal,
60 days old.
They use the ATA tonnage index, and tonnage is such a dated way to look at the trucking market.
You're gonna trigger me.
The other thing about the ATA data is it's ATA members.
Right.
One of the fascinating things as I've dug into sort of this whole concept that there's, I grew up in a trucking family, and I was told that eventually the industry would consolidate and there would be like 10 big trucking companies that would run it. We have seen the exact opposite. That actually played out so wrong that if you go back to 2000 and I think it's 2010, 58% of the capacity was held by the companies with 1,000 trucks or more. Now it's like 31%.
Right.
The growth has been in the small trucker, and it's been in the SMB owner-operator, and it's been the proliferation of freight brokerage. Intermodal has really come of age. And a lot of that data is not captured in that tonnage index, which is why, and it tends to skew towards bigger companies, which tend to have more insulated contract freight, and it runs on a pretty significant lag to what the rest of the market sees.
Also, it's based on weight. That's not
No,
how
a lot of truckload goods, unless you're hauling
I don't know if anybody notices.
heavy goods or bulk, oil, tanker, logs.
What weighs more, a pound of feathers or a pound of rocks?
Tonnage is a really challenging.
Especially with think about the freight that we just talked about a lot of.
A lot
it's
of
all
what we talk about is
freight.
consumer freight,
Yeah.
and a lot of the folks that are in freight brokerage tend to haul some portion of consumer freight. That's where the action is in the freight market. There is action in bulk, and there's action in tanker. Tanker stuff tends to be contracted. Grain hauling is its own industry, but most of the action that freight brokers play in the industry is really in the consumer side and the retail side of the market, because that's where the high volume shippers are.
How many publicly traded companies talk about how much weight they hauled?
The LTO guys do talk about that.
In a revenue per hundredweight standpoint, which don't get me started. I got one more chart that I want to pull up before I want to leave time for Q&A, audience questions and whatnot. But so I've got the NTIL pulled up on my end, if we can get that one going. So this is the average dry van, excluding total estimated cost of fuel, spot rate for the last 3 years. This guy's growing year over year, but minimally. I think inflation probably has something to do with it a little bit in terms of actually being able to pass along some operating cost increases. But where do you see this index in 3 months go?
I think it's going to look a lot like, I think we'll see an increase starting in October.
Okay.
I think two things are going to happen. You have concentration in lane. Like I think you're going to see longer lengths of haul. That actually impacts rates in a different way because it actually can lower it. But I think you're going to see, like, what's going to happen in the latter half of September and October is a lot of those retail goods are going to be sitting in warehouses in San Bernardino, California, and in Phoenix, Arizona, and retailers are going to be trying to get that stuff into the stores. And when they do, into their distribution centers and into the stores. And when they do that, that's going to cause some pressure on the index because a lot of that, great thing about the holidays, a lot of it's spot capacity, because 40% of retail sales are really within 2 months, that fourth quarter, that holiday surge. And so retailers end up using a lot of incremental surge capacity, and it ends up in the spot market.
Yeah, I tend to agree with you. And of course, a lot of the spot market freight in the fourth quarter is long haul freight because we lose that intermodal capacity.
Until you get into really like mid-November where you start to get shorter hauls because it's gone from the warehouses on the coast to the distribution centers, and then we're now in a situation where you get freight.
Yeah, the mechanism that I called out earlier where we saw the Los Angeles rail chart, where we saw the domestic intermodal is an option right now. You've got a length of time before that order fulfillment.
Intermodal is interesting for another 45 days.
Yeah.
And if it's not out of California by the first week of November onto a container or into a warehouse or distribution center, it may not make the holidays. Like you need 6 weeks typically to go from the warehouses on the coast into some type of distribution network to get it into the end consumer's hands, into either the retail store or at a warehouse that's near your house.
Right. And we typically see the long haul freight. If anybody has a Sonar subscription, wants to pull up long haul outbound tender volumes for Los Angeles, look at the seasonality on that bad boy over the last 5 years. You'll see it really grow in November. Now, kind of ignore COVID. All right. Let's see if there's any Q&A.
At this point, we will go ahead and take some questions from those of you who are live in our audience. So if you have a question, please raise your hand and the lovely Kaylee will bring you a microphone so everyone listening in can hear you.
Anyone? Me and Craig can keep talking. Here we go.
Y'all mentioned at the beginning that Q4 is the time where they're making a lot of their money. But I noticed in a couple of the charts, I think there was OTVI, around Q4, it showed a drop, or at least that it wasn't spiking up. And so I was wondering if those were just specific years where there wasn't a lot of money being made, or if there's something else we should be looking for.
That's a good question. So demand is not the same thing as kind of that tightening of capacity. If you remember the tender rejection chart, tender rejection rates spike in the fourth quarter. If you looked at the spot rates over the last several years outside of COVID, rates spike in the fourth quarter. And it's because it's not necessarily a pure demand side event. More trucking volume moves in the middle of the year, in June. Like that's actually the busiest volume side. The difference is the sense of urgency for a shipper is much greater in the fourth quarter. So that's where a lot of that happens. It's retail centric, very retail centric.
It's also like the haul changes.
Yeah.
I mean, one of the things about, you see a lot of freight in the summer, a lot of those are building materials.
Short haul.
And people, for the most part, don't take building materials over long distances. Just, there's a pretty significant cost. Transportation as a percent of the goods is expensive. And a lot of it's beverage. Like a lot of what you see in the summer are things that are going on much shorter hauls. And so it may have more volume of transaction, but it's not taking as much, on a mileage basis, it's not taking as much capacity out of the market. What you see in the fourth quarter is a combination of factors where capacity leaves the market because people go home, Thanksgiving,
Home time
for Christmas. And also you see a lot, like you said, a lot of length of hauls. And it's an interesting time because, Christmas tree season picks up, which, people are hauling Christmas trees from as far as Washington into Southern California and Washington into all sorts of places. You see things like, produce, apple orchard season up in Washington. Shout out to Washington today. But like you see a lot of these things that happen during the fourth quarter. We used to, wrapping paper was a huge part of our business in November.
Yeah, Christmas tree season by itself
is big. But you don't remember, it was always hard to predict the exact date. That's the problem with produce, is like the exact date is really...
It moves a little bit.
It moves a little bit, can move within a week. Even like trying to figure out what day the leaves change color is sort of the same thing on produce. Is like, a lot of it's sort of environmental driven.
Yeah, and of course, produce season this year out west was not a huge deal, or not as big of a deal. So sometimes you have these robust produce harvests. Yields are huge, and then some years they're kind of mild. Anyone else?
All right, who's next?
Good afternoon. Quick question here. Do you expect the rate of acquisitions to continue into 2025, possibly through 2025, or has that peaked at this point, from an economics perspective, in all disciplines of the industry?
Joe, are you talking about mergers of companies?
Yes. Again, I hate to use the word sort of because of the fallout, but I'll leave that to how you want to interpret it. But yeah, just maybe speak on that a little bit.
I actually think there's a lot less deals now than there have been. Like I remember back when we first started FreightWaves recovering the industry in 2017. And I remember in 2018, was it 2018, 2017, 2018, just the surge of deals. And I remember thinking we needed to get a deal person full time because it was just an onslaught of just news articles about transactions. There were particularly in the logistics space, there was a lot of mergers and acquisitions that took place in third-party logistics. It's actually been a pretty slow market. I think what you're seeing right now is you're seeing some companies be opportunistic. RXO is probably the best example, Coyote.
Yeah.
Coyote's a pretty unique case. Coyote was sort of inside of UPS was somewhat broken, whereas RXO has the chance to take something that and sort of create some new energy into it. In the asset trucking business, we see transactions. Knight-Swift has been incredibly aggressive. Heartland is probably out of the game for acquisitions for some period of time. They got to get their act together.
Their last two acquisitions are the reason they're in
the whole business for Heartland has changed. But I wouldn't call this a robust M&A market. I mean, the Knight-Swift US Express acquisition was opportunistic for Knight-Swift. I think you'll see some opportunistic deals, but I would not call this a robust M&A season.
Yeah, no, there's no way, especially on the asset-based side. I think we've seen the majority of the consolidation efforts take place last year. You mentioned Heartland. They're struggling with that acquisition themselves, or those two acquisitions.
Anybody in the for-hire over-the-road business has struggled to make that work.
And well, now every single major carrier, excluding the acquisition standpoint, in the terms of like fleet growth, they're all fleet negative year over year. Every single one of them. When you talk about like accounting for the acquisitions, all across the board, they are now showing.
Well, it's interesting because if you think about public markets, these are not growth companies.
Right.
Like they're not treated the way growth companies are treated. And so what is rewarded by Wall Street are highly profitable companies that focus on unit economics and run really clean operations. You could probably go back 20 years ago and Wall Street would reward growth. Yeah. We don't see that today. Right. Is that Wall Street expects public trucking companies to drive profitability and efficiency, not to drive growth. Now, they'll take growth, but they don't want it at the expense of operational efficiency, as we've seen with Heartland. They don't like it. You could even argue Ford Airs. Whatever happened there, that has not been something that Wall Street wants to reward. So I think a lot of the growth is they want to see operational efficiency. I think Knight's model is interesting. I mean, Knight made an opportunistic acquisition US Express because of some of the issues at US Express. Right. Where it's really investing its capital is not in the for-hire truckload market, but more in the dedicated and the LTL side of the business.
Yeah. Any other questions? If they don't have any.
Twofer. Part one, intermodal fourth quarter, looking at one of the big stories in Q1 was hunt between the 53-foot containers and then you had the ocean containers, 40-foot. Will truckload get a share, or is this a situation moving in Q3, Q4 that we're going to see a situation where maybe a hunt or someone with the domestic containers can win, or is it still enough fluidity in the marketplace that we'll see those 40-foot boxes go further inland and then come back out? If that makes sense.
I mean, a lot of Hunt's intermodal business is actually domestic. I mean, that's where a lot of their
almost all
volume is. Yeah. They don't actually take stuff off the ship and move it. They're not moving a Maersk container.
Right.
It is going into a distribution center and then ultimately being stripped from a container. I think intermodal wins when trucking wins, and we need trucking to heat up to a point where the delta between intermodal is such that trucking is such that intermodal becomes a far more attractive proposition. But I think some of that's already happening. Like one of the nice things that intermodal offers you is time, like slower time, and patience, and you don't have to put it in a warehouse. We're already seeing some of this volume. I would be relatively bullish on intermodal as an asset class over the next couple of months because there is just so much volume out there.
Yeah, the one weakness in intermodal is the fact that trucking is struggling. Like it's a weird thing to say, but it's because of the fact that they can't increase their rates. Like we saw Knight-Swift, we saw J.B. Hunt struggle on their last couple of reports not because they didn't have volume, but because they didn't have good rates.
Yeah.
like they weren't able to expand their margins very effectively. So profitability is what they're struggling with right now because they cannot increase rates because trucking is operating at such a low cost level.
Yeah, and that should change hopefully by the end of the year, and things will be better.
Yeah, I would say definitely next year would be better for.
So I got a closing question.
Okay.
How's Tennessee going to finish this year?
I mean, national champions.
This is your year?
Yeah, this is it. I mean,
Right.
Nico is our quarterback. What about Baylor? What's that?
I think we're going to have a pretty abysmal year.
Yeah.
So
Standard.
I figured if I get that right, like at least I get some point of clarity.
So who's your national champion?
Oh, that's a good one. I don't know. It's such a shakeup year. I mean, Alabama is always a safe bet, but Alabama's got
No,
it's
I'm out.
totally done. Michigan's got who knows, man? This is a year of complete shakeup.
I think it's the year of the duck.
You think Oregon?
I think it's the year of the duck. Watch
Interesting.
out. Watch out for the Ducks.
They're in a new conference though. When you're in the Pac-12, there were 3 schools that mattered out there.
I think they're going to take the Big Ten.
It's like looking at A&M
Yeah.
and looking at how strong A&M was in the Big 12 and actually they weren't that strong, but looking at what they came in and everybody thought they were going to win the SEC, they didn't do it. You could say the same thing. I think Oregon in a new conference is going to struggle a lot more because just the travel alone is going to
That's a good point.
is going to make them tired.
I didn't even think about that.
I mean, that's going to be a really, really, really tough thing for those guys. So, Oklahoma has always been a strong contender. Oklahoma is the only Big 12 team that actually has been able to hold a candle to SEC on a consistent basis. It is when they play the SEC, they're the only team that actually you have a confidence that they could win the game. Whereas Texas has not been able to demonstrate that.
Oh, Texas. No, I mean, you don't think the quarterback cabinet back there that they have is gonna show up?
They have had all those resources and done nothing with it in the Big 12. I think they're gonna be a middle of the road
So I guess
SEC team.
I guess it's Georgia again.
I would say Georgia's probably Georgia's is as good chances of anybody.
Yeah, you can't say no to that. All right.
So.
All right, everybody, that is all of the time that we have for today. So thank you all so much for being here in the audience and for your great questions. And as well, thank you to Craig and Zach for sharing your insights, football predictions, and go Vols.